So where is Bitcoin's going? Now, this is the one where we link it up with inflation. This is the part 2 of the video. And here we go. Basically, as we said a while ago, and I'm sure people who have been watching me knows that, why has Bitcoin been doing this? Well, it's been doing that because the Federal Reserve is hiking rates and doing QT, quantitative tightening. If you've been watching my videos, you know what I'm talking about. And the thing is, it's basically doing that. Why? Because inflation is at an unacceptable level. They aim for that inflation around 2 to 2.5%. Inflation is now actually at like 8.5%. So, but the new CPI inflation figure is going to come out on Wednesday morning. So that's why this is an important broadcast. And so here, see, this is the exact day when inflation came out 5%, Bitcoin and just started tanking first, then came out around 6%, then Bitcoin tanked more and stocks tanked more, and then 7.9% and then 8.5%, somewhere around here. And now we've crashed here. That's where we are right now. And so I hope people should realize by now that, it's not about hodling or plan B or whatever, he says. It's basically about the Federal Reserve liquidity, and the Fed looks at inflation. Why do I think this broadcast is important? Now, here's the reason. Tomorrow, we're going to have a CPI report, which they do once every month. This is not the main one that the Fed looks at. The Fed looks at what's called the core PCE, personal consumption expenditure, which is another measure of inflation. But tomorrow, the one that most of American citizens and Joe Biden would look at is this number here, the year-on-year CPI. So remember last time it came out to be 8.5%, freaked out a lot of people, freaked out Joe Biden, freaked out a lot of American citizens. Now, the new one they're expecting to be only at 8.1%. What does that mean? That means it's basically gone 5%, 6%, 7.9%, 85%, and now coming down to 8.1%. Even if they miss, that's what the analysts are expecting on Wall Street. Even if they miss, even if it goes to say 8.2, 8.3, 8.4%, right? Even if it's higher than what's expected, it's still lower than 8.5%. So the thing is, if we look at it, it basically means, okay, it's actually turning down for the first time for 7 months now, or 7 or 8 months now. That is something what they call peak inflation. Okay, so Goldman's, it's saying peak inflation is kind of happening. Now, it might sound like, peak inflation might sound like one of those really boring economic terms, but I kid you not, this is probably about the most important thing you're going to see. Peak inflation happens, and then basically the markets just take off. The market just going to huge boom. That's why I've been saying we're probably near bottom, especially if on Wednesday morning, if we can get a really good, like something like 8.1%, I think the markets will be happy. Right on expectation, right on target. Or like if it can be like 8.0 or 7.9, the market's just going to jump. Probably rally for another 2-3 weeks after that. So why is that? Because historically, if you look at it every time, so this blue line here is the inflation number. Every time it goes up and it's coming down, creates a peak. Peak inflation means inflation's falling. Stock market, that's the green line, just takes off. That's the S&P 500. And again, people are probably wondering why we're looking at S&P 500. As I've said 1,000 times, Bitcoin basically follows the NASDAQ, right? NASDAQ is kind of highly correlated with the S&P 500. All the folks in my Discord knows this, and this video is going out to my Discord first, and then, in a day or 3, I put it out onto social media. So here's the thing. Now, we are looking back almost 70 years ago, that at the end of World War II, 1948, 51, and look, we had peak inflation here, and the market just went up, right? Peak inflation here, and the market went up. Peak inflation here, market went up. Not a huge bounce and came back down, but I'll tell you why that is. And another peak inflation here, market went up, not a huge bounce and came back down, but then look at how much it went up. Peak inflation here, right? right? Peaked and fell back, right? That's the bottom of the market, and the stock market, look how much it went up. This is the only exception. Why? Because it's 2008 GFC. That peak inflation is actually caused by the American economy tanking. That was a Great Depression. That was not like a recession. That's when they had to invent QE, print money and pump it into the economy. But in 2011, look at this, peak inflation, right? Bottom of the market, right? Look how much has rallied there. And they're predicting we could have peak inflation. Why? Because look at this number here. That's 8, that's 9. So 8.5% is what we had. And now imagine if we go 8.1%, so down there. If that's what it does tomorrow, on Wednesday morning, imagine what that means. So in the last 70 years, we have 1, 2, 3, 4, 5, 6, 7, 8, 9 times. Previous 8 times, 7 times it proved to be the exact bottom of the market, right? Only once it didn't work. And that was the 2008 GFC. I don't think we're quite like the 2008 GFC right now, because 2008 GFC, people don't understand how bad that was. That was actually the end of the world, basically, because you had banks such as Bear Stearns and Lehman Brothers that have been 100-year-old companies on Wall Street, investment banks that were going bankrupt. All of Wall Street was going to go bankrupt because there's a contagion effect. I don't think we're there yet. Stagflation is bad, but it's not that kind of panic. It's not that kind of Armageddon. So now I just want to come back and address this. Why did we get the least bounce out of these two? So this is 1973. 1974. 1970. 1974 and 1980. So check this out. We had a bounce here. Now these are logarithmic. Remember, these are logarithmic graphs. So this bounced from like 70 to 105. That's still like a 50% bounce. That's still pretty big. But then came down, crashed even more. But remember, the bounce went on for this is like a year or two. And from here, this is from 63, bounced up to, say, here is about 100. That's still like a 70% bounce, and then came down, right? Again, here is 1980. It's still, that still lasted about 9 months to a year. Still a pretty big bounce, and then came down. So these three bounces, the timing was pretty much perfect, as you can see by the peak inflation. And the bounces were there, and they're actually pretty big, because this is, as I say, it's a logarithmic graph, but nowhere near as big as some of these. Why is that? Because this 70s, 70, 74, 80, these 3 times were what they called stagflation. And this is what I'm expecting, because we're now in a stagflationary era. First of all, you look at the inflation number, 8.5%. They've actually changed the way they measure inflation right now. That number should be a lot higher. Should be like 14, 15, 16%. Should be like here. They've since changed the way they measure inflation in the last 40 years. So therefore, this number appears lower, but in reality, it's actually about here. So this one is actually comparable to here. That would make it the highest in post-war America, except for the stagflationary period. That's point number one. Point number two being that this also this is also a stagflationary period, as we know. I've been saying this quite a lot. GDP was actually negative 1.4%, which means we're probably in a recession, very likely already. And you've got inflation at, at least 8.5%, even by their own admission. To me, it's probably at least 12 to 14%. So we're in a stagflationary period. So what are we going to see? One of these big moves? If we get peak inflation here, are we going to see one of these big moves where it just goes like this? Like that's like on a logarithmic scale, that went from about 1,000 to about 4,500 on on the SP 500. That's like a 4.5x gain for the stock market. If that is essentially the entire lifetime of Bitcoin. Of course, I don't think it's going to do that sort of insane gain. It's going to be, so I'm looking at the 70s, I'm thinking it's more like this. Here's the bottom, bounces for another year, year and a half, and then flattens out or goes down. Bounces for, this is the shortest way in 1980 because there's the highest inflation. Bounces for what, like that's about, I'd say 6 to 9 months, 9 months, and then comes down. Still like a 20-30% bounce in the stock market. This one bounces for like 2 years, and but remember this was inflation was only at like 6% or so. And if we measure it, using the way we measure now, that will be only like 3.5%. So this is not as comparable. So this one bounced for about 2 years, made it like a 50% bounce on the stock index, and then came down. So what I think is most likely compared to history is this bounce and this bounce, which means at most 18 month, shortest, say 6 to 9 month, and stocks peak, and then we come back down. And you can see that this one came right back to where the bounce started. But keep in mind, back then they didn't have something called QE, which is something that they invented, like I said, in 2008. They didn't have this whole printing money business. Now they're actually unwinding. They're actually not only printing, they're actually taking money out of the market. If they keep that up, I'm not saying they will, but if they keep that up, that's really, really going to hurt the market. So all I can say is, looking at history, because this is really different from history, looking at the stagflationary periods, I think we are going to get, some sort of major bounce in the market. If we on Wednesday get the super low, inflation figure, if we don't get it on Wednesday morning, then next month, then it would be something like June the 10th is the next report. So it's one of those two. I think we might get it. The reason why, am I just guessing, or am I relying on analysts? Because analysts get it wrong pretty often. These pencil pushers on Wall Street to get this number right. Okay, the reason why I also think so is because of this. Check this out. Now we all know that. Let's have a look. Say for example the SP 500. The SP 500. We all know. SP 500 went down minus 3.2% yesterday. That's the NASDAQ, right? NASDAQ 100 went down 4% yesterday, right? But look at what happened to the bonds yesterday. Let's have a look at the 10-year. Let's first have a look at the US 2-year. Okay, US 2-year, let's have a look at this. This was yesterday, right? This is today, we're just starting. US hasn't really started yet. And this is going to be tomorrow when the inflation number comes out, right? So they were actually coming down. So this is saying that they expect that the average interest rate over the next 3 years, over the next 2 years, for the US government is actually going to get to about 2.8%. Well, because of high inflation, because Fed's going to keep on hiking rates. But then actually started falling, right? In fact, it fell down to, it made a big fall that day, and it's falling as we speak right now. Why is that? Because likely it's sensing that we might get a lower inflation number here. Also, if we look at the US 10-year treasuries, so that's saying what will be the US treasury rate for the next, on average, the next 10 years. It's also falling. Look at that. It's falling, and that's falling, right? So basically, we've had 2 days of falling. This could, I don't want to say it's the peak, but it is possible that this might be some sort of peak, or at least a short-term peak at around 3.2%. So in other words, US 10-year yields, 2-year yields, long-term interest rates are falling. Why are they falling? Because they are anticipating that the tomorrow on Wednesday morning, the inflation numbers coming out could be like 8.1% or even possibly even lower, like 8%, 7%, something like that. So let's have a look at the US CPI data. We might have to do a year-on-year data. Okay. Okay, the US CPI, hang on one sec. Okay, so basically this is the chart we're looking at, and if you look at it, 8.5%, if it's 8.1% tomorrow as they expect, then that means we've topped. We're likely heading down, that's why they call it peak inflation. That's what I was saying before, even if they get it to 8 it's not as good as imagined, 8.2, 8.3, 8.4, then that means still lower. It's still turning down, right? This is the 70s, and 80s. So that's the three inflation peaks we're comparing before on the previous chart. That's when peak inflation happened and stocks just bounced there, right? Now, obviously, Bitcoin wasn't invented until about here. So, and we do know that Bitcoin has been falling stocks. So if stocks were to bounce 20, 30%, 50%, chances are Bitcoin should make a massive, massive bounce. So tomorrow, Wednesday morning, would be a great opportunity for Bitcoin to do that. And as we've seen, the 10-year yield and 2-year yield are falling right now. So in fact, it's below 3% now. So fingers crossed. I think we'll get I think 28K, worst comes to worst, 26.5K will be the bottom. If not, we've already bottomed with Bitcoin and possibly stocks. Okay, thank you for your time, guys. I'll catch you next time.